Assalamualaikum and salam sejahtera. Welcome to FAR110 lecture line, and this video is discussing the topic of recording inventories. The Financial Reporting Standard 102 it, regarding the inventories. It says that the inventories are asset that is current asset, and the purpose of inventories firstly is to be held for sale in ordinary course of the business. Means that what are the finished good trading, and it can be an inventories in the process of productions for the such sales. For example, the production is not really finished yet, so in between in progress, so it can be categorized in inventories. And the third one is in the form of raw materials that is to be consumed in the production process or in to provide the services of the company. The types of inventories can be said that if for merchandising enterprise, where the business is engaged in buying goods for resale without any further processing, so it will sell off the product or the items in its original form. So it will call the inventories of finished goods. However, for manufacturing enterprise, where the business has engaging the converting the raw materials into a finished good. So let's say in the production line, so you have a finished goods, means that the item or the product is already finished processing, and the second inventories would be categorized as work in progress, means that it's not really finished yet, but in the process of becoming the finished goods. And another inventories will be called raw materials. So these three types of inventories more regarding the manufacturing enterprise. You will cover this when you when we learn FAR subject of FAR 160. So you will have the manufacturing companies or manufacturing accounts where you need to show how much is the finished goods, how much is in work in progress, and also what are the value of raw materials. So those three are also called inventories. So which actually inventory system do we choose? Because we have perpetual and we have periodic inventory system. So usually will be depends on the nature of the business itself. If the business makes numerous and in large number of sales of products, which is a very relatively small unit cost or very low value items per unit. For example, the grocery sales, the grocery store or grocery kedai runcit. So this nature of business have many products, many items, various variety of items in the shop, and it has low value for per item. So it is suitable to use periodic inventory system. However, for businesses that makes fewer sales and has a higher cost per unit, it is more suitable to adopt the perpetual inventory system. For example, for businesses that sell off cars or lorries or big items uh, or high value of items such as the electrical appliances, refrigerator for commercials. So these are items that high value and make few sales. Any business that can be supported with in information technology products or hardware and software, so the business can adopt um, the perpetual inventory system. So you need a very high and complex um, computer system that can monitor your inventory. For example, nowadays we have barcode system or QR system that attach to each item of the product, so you can just scan them and the computer will read which item is moved in or out of your store or the warehouse. So the business can adopt the perpetual uh, inventory system. However, in Malaysia, most of company rather adopting the periodic compared to perpetual. So the perpetual inventory system is keeping a detailed records of cost each items of inventory whenever it being purchased and sell off. So every items will be monitored or will be kept tracked by the system, and the records will continuously show the inventories. What are the inventories on hand, so it can be extracted the informations in time, how many on hand. And also the perpetual inventory system will update continuously the inventory and the cost of goods sold value for each purchase and sales transactions. Whenever there is a purchase, then the value of inventory will be updated in real time, and the cost of goods sold will be updated whenever there is a sales transactions. So you need to track off which cost of inventory is being sold, including the purchase of returns or the purchase of discount and also the sales of returns. So any transactions of these will affect the inventory value and also will affect the cost of goods sold value. So the perpetual inventory systems is updating in the informations regularly. And each sales that occurs, whenever the sales occurs, your value of cost of goods sold will be determined at that particular time. That if we use the perpetual inventory system, so many say that it is better to adopt the perpetual inventory system because it can provide a better control over the inventories compared to the periodic inventory system, because the control can be done whenever the records of quantities on hand is being showed every time they purchase or sell off the goods, the inventory. So actually you can assure that the records would be the same as the actual amount on hand. So if the records shows any shortages, let's say you went out to the store and calculate the inventories on hand, and it is not the same with the records. So you find that it has a shortages. So once you discover any weakness or discover these shortages, so you can investigate why there is a discrepancy between the records and the inventory on hand. So you can have a better control over your inventories. So the periodic inventory system, however, will not keep the detail of inventory records throughout the accounting year, the accounting period. So you will not have the accurate records of inventory, then you cannot retrieve the informations at any time that you want, because you are not keeping up the detailed records of inventory at the moment when you purchase and also you sell off the inventory items. So the periodic inventory system only determine the value of cost of goods sold at the end of the accounting year end. So normally we will calculate at the end of the year. For example, your accounting year end at 31st December. So around that time, then you will calculate the cost of goods sold and also the inventory value. So if the perpetual inventory system, inventory value and cost of goods sold is updated continuously whenever the purchase and the sales transaction occur. However, the periodic inventory system will not update the inventory value and also cost of goods sold value not continuously updated. So it's only determined at the end of the year. So your task is very simple. So you only need to calculate the value of inventory and also cost of goods sold once a year. Normally, the value of inventory is being determined at the end of the year by an activity we call as physical stock check, or in Malaysia we always say that stock take. So whenever that activity is being done, so you will know what is the physical the inventory amount or value at that time once you take on the physical inventory count. So when you adopt the periodic inventory system, the steps that are necessary to follow in determining the cost of goods sold under periodic inventory system. So you will determine the cost of goods on hand at the beginning of the accounting periods. Means that you will know the value of opening inventory for the year, and then you need to add the cost of goods purchased. Means that purchases deduct with purchases returns and add off the carriage inwards or transportations, or the cost that will increase the cost of the goods purchased. And also you need to deduct with the purchase discount or discount received. Then in the at last, the subtract the cost of goods goods on hand at the end of accounting period. So these three steps will be followed to determine the cost of goods sold if you use the periodic inventory system. And these determinations only be done at the end of the accounting period. So now we will discuss on how it be recorded if you adopt perpetual compared to periodic system. So whenever there's a transactions of purchases, whenever whether it's in cash or on credit. So the periodic system, normally we will we all have learned that we will debit the purchases account and we will credit the cash account if we purchase the goods on cash. However, you will record debit purchases, credit account payable, the name of that supplier, if you purchase on credit. However, if you adopt perpetual inventory system, you will record debit inventory account and credit cash if you purchase on cash, and debit inventory, credit account payable, the name of your supplier, if you purchase on credit. So you can see that if you adopt perpetual, there is no purchases account because you will debit the inventory account. You are no longer required to open purchases account if you adopt perpetual inventory system. Next, transactions on purchases return, or another word, another term that you can use is return outwards. So when the purchases return transactions occur, you will debit account payable and credit return outwards or purchases returns for periodic inventory system. However, if you adopt perpetual inventory system, you will debit account payable, credit inventory. You are no longer required to open a return outwards account anymore because you will credit inventory. For transactions that involve the cost that would increase the cost of goods sold, for example, transactions of carriage inwards, you are paying the transportation for bring the goods from suppliers' premises to business premises, our premises. So in periodic inventory system, we will debit carriage inwards account and credit cash. Or you need to pay a tax for the goods purchased. So you will debit the tax account, tax on goods account, and you will credit cash if you pay by cash, or if it include in the invoice, then you will credit the account payable. So the perpetual will be different records. If you adopt perpetual inventory system, this particular transactions will be different. That is, you will debit inventory account and credit the cash. You are no longer required to open the carriage inwards account or any other accounts that relate in increasing the cost of goods. For the purchases discount or discount received transactions, if you use periodic inventory system, your records will be debit account payable, the name of your supplier, and you will credit cash, which is the amount that you paid, and you will credit the discount that you received from the supplier. That if you use periodic inventory system. However, if you adopt perpetual inventory system, you will debit account payable, credit the cash, and credit the inventory. So the discount received account is no longer exist if you use perpetual inventory system. For the sales transactions, whether you have cash sales or credit sales, for periodic inventory system, normally we will record as debit the cash if you sell off on cash. So you debit the cash and credit sales, or you debit account receivables, the name of your customer, and credit sales if you sell on credit. However, for perpetual inventory system, it will be different in terms of additional record. That is, you need to debit the cost of goods sold account and credit the inventory. Always remember, the inventory must be in the cost value, the price that you pay when you purchase the inventory. If you sell off the goods or the items, you will record on the sales price. Okay, I repeat, for sales transactions, when you debit cash and credit sales, you will use the sales price. However, for recording the cost of goods sold and inventory, you must use the cost price. What is the price that you pay for that particular inventory when you purchase that particular inventory? So you need to find out how much is the cost of the inventory when you record the debit, cost of goods sold, and credit the inventory. So you have additional work to record the cost of goods sold and updating the inventory that been sell off. For periodic inventory system, we have no entry at all to update the cost of goods sold. That is the difference. For sales return or return inwards, again, the periodic and perpetual inventory system, you still need to record debit return inwards or sales return and credit the account receivables, the name of your customer. However, for perpetual inventory system, you need to have additional accounting records where you need to debit inventory and credit the cost of goods sold account. Again, you must remember for sales return value and the account receivables value, that value is on sales price. However, for the inventory and the cost of goods sold must be in the cost value. So you need to find out uh, that particular inventory, what is the cost or the purchase value of that inventory. For periodic inventory system, when sales returns occur or the transactions occur, there is no entry for updating the cost of goods sold value for periodic inventory system. For sales discount or discount allowed, if you have that transactions, you allow the customer to pay less. So you need to debit the cash or bank and debit the discount allowed, the sales discount, and you will credit the account receivables, the name of your customer. So the perpetual and periodic inventory system, the records will be the same because it does not involve the movement of inventory. That's why the records are the same. If you compare the determinations of cost of goods sold, um, as I explained earlier, the periodic inventory system will determine the cost of goods sold at the end of the year. So your profit or loss account will have sales revenue, deduct the sales return, and deduct the sales discount to arrive the net sales value, and then you need to determine the cost of goods sold value, where you need to have the opening inventory value. Then you add the purchases less purchases returned less discount received, and then you need to add the amount of cost that related to increase the cost of your inventory, such as the carriage inwards, tax on the goods purchased, or the insurance that you need to pay for the goods on purchase. And you will deduct the closing inventories, then you will have the value of cost of goods sold. Once you determine what is the value of cost of goods sold, then you deduct with the net sales, then you will arrive to the value of gross profit. So it's a long way to get the value of your gross profit if you use the periodic inventory system. However, for you, if you adopt the perpetual inventory system, your job at the end of the year is being less because the cost of goods sold has been determined every time you sell off the goods. So you do not need to calculate the cost of goods sold at the end of the year because the system already show you the value of cost of goods sold at that particular time. So your list will be less than the periodic inventory system, because you only need to have the sales revenue deduct with the sales return and also the sales discount if you have. Then the net sale will be deduct with the cost of goods sold to arrive the amount of gross profit. The comparison between the perpetual and periodic also will have a differences in accounting equation effect. For example, we look at the example on the purchase on credit. So you're explaining the accounting equation effect if you use periodic inventory system. So your explanations on the effect, the equation effect, or if the transactions of purchase on credit occurs, so you will add the liability 5,000, for example, and then you will deduct in the columns of expenses under the owner's equity, because it will reduce the owner's equity value of 5,000. However, if you use perpetual inventory system, you will add the inventory account. So the inventory is classified as asset. So you will add asset 5,000 and you will add the liability because you purchase on credit, your liability increase. So those are the difference. Now we look into example of the purchases returns and discount received. So if you're using periodic inventory system, when you have a return, for example, the return value is 200 ringgit. So the effect you will explain is will be deduct the liability with 200 ringgit and the expenses has been reduced. So your effect to earnest equity will be increased at 200 ringgit under the expenses column. And when you pay, and then you pay to the supplier and you receive the discount from the supplier, so your total liability means that you full settlement the debt to the supplier, so you will deduct 4,800 ringgit full settlement, and after taking account the purchases returns. So your liability is deducted with 4,800 ringgit, and if you receive the discount of 100 ringgit, so you will increase the revenue at 100 ringgit of owner's equity, and the asset will be deducted 4,700. That is the actual amount you pay to the supplier. That is the effect if you use periodic inventory system. However, for perpetual inventory systems, when you pay, when you have returns and pay the supplier and you receive a discount, they will be different, because let's say you return 200 ringgit, just the same as the example if you use the periodic. So you will deduct the liability of 200 ringgit and you deduct at the asset column, because that 200 ringgit you will deduct from the inventory account. And also for discount received, you will put under the asset, because that 100 ringgit is the effect of inventory amount reduced of 100 ringgit. And for sales transactions, for example, we look into the sales on credit. So if you use periodic inventory system, your accounting equation effect will be explained as increase in assets, meaning that you have a debt from customer 6,500 ringgit, and the revenue, the sales account increased 6,500 ringgit. So this is on the sales price. So if you use a perpetual inventory system, again, you will record the same as periodic. 6,500 ringgit increase in asset, and the revenue increase in 6,500 ringgit, because this is based on the selling price. However, you need to add up, adjust, update the cost of goods sold once you sell off the inventory. So you need to deduct what is the actual cost for that particular inventory sold. For example, we assume we taken out the 5,000 ringgit as the cost of inventory. So you need to have another column under the owner's equity, the cost of goods sold. So you will deduct that 5,000 ringgit in that column, because the cost of goods sold is more or less similar to the expenses that will reduce the owner's equity whenever there is an increase on cost of goods sold. Okay, that's it for now. Thank you for watching this video. Watch out for the next video for the next topic. Bye bye.